So you're telling me you've been buying stocks without looking at the liquidity of the company? Well, that could be quite a fatal mistake. And before you tell me there's no way $1 billion company can have liquidity issues, well, you would be mistaken, as literally Bed Bath & Beyond, $1 billion company, is going bankrupt due to, drumroll please, liquidity issues. So today, I'll be showing you 2 liquidity ratios you need to look at for every company before you buy their stock, because otherwise you could end up buying a stock like Bed Bath & Beyond that end up going bankrupt, meaning you could end up losing all your money, being told by your parents you can no longer invest anymore, or just being the laughing stock of your friend group. And well, I definitely don't want that for you, so let's get into it. Now the first liquidity ratio is the current ratio, and the second ratio is arguably the most important liquidity ratio you should be looking at before buying a stock, but we'll come back to that right after we finish talking about the current ratio. So what is the current ratio? Well, simply, it is the company's current assets divided by the company's current liabilities. Therefore, non-current assets and non-current liabilities are not included in the calculation, as they relate to a period of greater than 12 months. So now you know how to calculate the current ratio. Cool. But what on earth does this figure actually mean? Well, the current ratio shows you if a company is able to pay its short-term obligations or obligations that fall due within the next 12 months. Now, why is this so important? Well, let's say your friend gave you $100 and you have to pay him back now, but you only have $50, which means you can't pay him back. But luckily you got a nice friend, so he just says, forget about it. Well, in the business world, if a company is not able to pay its short-term obligations, the world is not going to be as forgiving and the company can get into financial difficulty. Now, to explain what this figure actually means, if a company has a current ratio of above 1, this is good, as this means the company has more current assets than current liabilities. But if a company has a current ratio of less than 1, this is bad, as this means the company has more current liabilities than current assets. For example, let's say random company SuperValue has current assets of 1 million and total current liabilities of 500k. 1 million divided by 500k equals 2. So SuperValue's current ratio of 2 means for every $1 of the company's total current liabilities, SuperValue has $2 of current assets to cover its short-term obligations. Now the second liquidity ratio, which I think is the more important ratio to be looking at a company's financial position, is the quick ratio. Now what is the difference between the current ratio and the quick ratio? Well, not very much actually, except for one very important difference. When you're calculating the quick ratio, it's the current assets less inventory and prepayments divided by total current liabilities. Now, why is inventory and prepayments excluded from this calculation? Well, simply, it is because the quick ratio shows how quickly a company can turn its assets into cash to cover its immediate obligations. Now, for example, inventory, because it is slow moving or can be idle, this means inventory is hard to turn into cash quickly to cover the company's immediate obligations. Therefore, a company could actually have a good current ratio but a bad quick ratio, as it's not able to turn its assets into cash fast enough to cover its immediate short-term obligations. Now back to SuperValue. Let's say they had current assets, less inventory and prepayments of 750,000 and total current liabilities of 1 million. 750,000 divided by a million equals 0.75. Now this means SuperValue has a quick ratio of 0.75, which isn't very good for the company, as it means SuperValue only has 75 cents of current assets to cover every $1 of its total current liabilities. Now, does this mean you have to go and calculate the current ratio and quick ratio for every company you look at? Thankfully not, as that would be very painful. Luckily, there are many tools you can just use online, such as simply Googling a company's quick ratio or current ratio. However, it's still important to have an understanding of what the numbers actually mean, because otherwise, they're just random numbers. Anyway, so if you enjoyed the video or learned something new, you should hit the subscribe button right there. Also, YouTube thinks you enjoyed this video, so maybe you should check it out or not. Anyway, till next time, see you later.